With summer upon us and COVID hopefully behind us, we find ourselves reflecting on the past 16 months and looking forward to what we hope is a more normal second half of 2021. We are cautiously optimistic on the market going into July. With that said, we continue to be focused on three key points. Number one, economic indicators, especially jobs data and GDP growth. Number two, inflation and interest rates. And number three, earnings data. We're also keeping a close eye on COVID vaccination rates and variants, as well as geopolitical events, although these are very hard to forecast. The economic indicators we tend to focus on are jobless claims and JOLTS, or job openings. We focus on these indicators because they are leading economic indicators. The JOLTS figure reached an all-time high of 9.3 million for April of 2021, released early in June, which means that companies want to hire. This is good. Jobless claims released last week at 411,000 were consistent with the week prior. But if you look at the past 2 months, you will see that jobless claims are down 40% from the 742,000 figure posted the week ending April 3rd. Again, this is good news. In general, things are headed in the right direction, and we will continue to watch closely as unemployment insurance benefits expire and schools reopen this fall.
May's inflation read was up 5% versus May of last year, while core prices, which excludes energy and food, were up 3.8%. Now, there's a lot of talk that much of this increase is due to base effects, but we're not yet convinced of this. If you look at May's prices versus December of 2019, which is before COVID, core prices, again, excluding food and energy, increase measured the same at 3.8%, which suggests that the base effects are really only part of the issue. We believe it's more of a supply side issue. When you look at the producer price index, it clearly shows input costs are up since last year and even since December of 2019. We believe this is a result of 1, supply chain bottlenecks, and 2, labor shortages, both of which we expect to recede over the coming months. Labor supply should open up as unemployment benefits expire and schools reopen. And the supply chain is already opening back up, and you actually can already see this in commodity future pricing. As a point of reference, the Port of Los Angeles publishes data on a regular basis that shows vessels at anchor versus berth versus departed. And looking back on February 5th, the port had 24 vessels anchored. Now look back just a week ago, on June 24th, that number had reduced from 24 to only 5. So the bottleneck is being relieved, but of course it takes time for this to translate into more normalized prices in the marketplace. We believe that the markets will be okay if CPI hits the Federal Reserve's inflation target of 2% or even a little bit higher. Schwab actually did an interesting study that looked at stock market performance based on inflation rate scenarios. It found that below 2% inflation, the S&P 500 performed the best out of the other investment studies at 12.8% average annual total return. And then inflation between 2 and 4%, the S&P 500 performed second best at 11.8% average annual total return, only behind international stocks. And then in the third scenario, with inflation above 4%, the S&P 500 was the third best performer at 8.8% average annual total return, behind only commodities and gold, which is intuitive. Of course, the comparison ignores the potential volatility differences between the investments, but the point is that over the long haul, stocks tend to outperform most other investments, and only commodities and gold do better when inflation is north of 4%. And we don't believe that inflation is going to be north of 4% for a prolonged period of time.
Earnings expectations are at a post-financial crisis high. The estimated earnings growth rate for the S&P 500 for the second quarter is 61.9%. This is up from 52.5% for the first quarter. Since COVID, earnings expectations have been relatively low, and companies have continued to significantly outperform. Of the 103 companies who have provided guidance for this quarter, 64% are positive, which is well above the 5-year average of 37%. It seems that expectations have finally caught up with reality, So we believe the second half of 2021 will be a stock picker's market. This should suit our clients' portfolio as well. We tend to focus on high-quality companies with competitive advantages, durable business models, and low debt loads. At this point, we're still not excited about bonds though. Yield on the 10-year Treasury has come down since the 1.7% spike in March. Given a likely modest rise in inflation over the medium term and a need to increase interest rates by 2023, we think bonds don't offer much room for error, and the risk-reward trade-off is not in our favor at this point. We hope this brief video gives you a bit more color on our outlook for the market going into the second half of 2021. From all of us here at Evans May Wealth, we hope you have a great rest of the summer.